You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to the Pacesetter Pod, where we focus on addressing the strategy, growth, and performance challenges facing the leaders of food and agribusiness. I'm your host, Joe Mosier, and I really appreciate you choosing to spend your time with us today. Today, I'm joined on the podcast by Jim Byrum. Jim currently works for business advisory firm Riveron as a senior restructuring and management consultant as part of their food and ag practice, where he's been for the last 4 years. In today's conversation, we're going to dig into some of the major trends that are going to have a heavy impact on the operating environment across the entirety of the ag supply chain. Specifically, we're going to talk about the structural trends in agribusiness that are driving the consolidation that we continue to see, and what risks and opportunities that's going to create for you as an executive, as an owner, or an operator. And because this is such a big topic, I think it's really important that we share a bit about Jim's more than 40-year career in the industry, so that it's clear that the scope of his background is right-sized for the scope of the discussion. There's a lot here, but we'll try to go through it as quickly as possible and hit the high notes. So Jim has worked with manufacturers, distributors, and retailers of agricultural feed, fertility, and crop protection products. He's worked with grain handlers. He's worked with companies that supply services and products to all those that I mentioned. He has experience working closely with poultry, dairy, and the pork industries as well. Jim was a longtime leader of the Michigan Agribusiness Association, and during that time, he worked with hundreds of companies that operate throughout the Midwest and in Canada and represent virtually every segment of the agricultural industry. And in addition to what I mentioned before, this includes renewable fuel and bioenergy producers, fertilizer companies, seed companies, pesticide producers and distributors. He's worked on water quality and environmental stewardship conservation education programs, crop insurance, ag lending, mills, elevator, grain storage, grain handling, railroads, ports, fruits, vegetables, commodity producers. It probably would have been easier for me to talk to you about what Jim hasn't done than has done. The list goes on. He's also worked extensively with state and federal policy leaders and agencies to help level the playing field for U.S. agricultural companies. And finally, Jim has served on the board of the National Grain and Feed Association, the Agricultural Retailers of America, and the Fertilizer Institute. So while I take a breath, let me just say thank you, Jim, for joining us, and welcome to the Pacesetter Pod.
Joe, that pretty well kills the 30 minutes. Pleasure to be with you this morning, but the introduction is pretty, I appreciate your kindness of including all of that, and it makes me tired just to remember some of those things that I was involved in, but great to be with you.
There's nothing longer than the 30 seconds you have to sit through and listen to someone introduce you.
That's true.
No, fantastic. We're really excited to have you on the show and appreciate you carving time out of your schedule to spend the time with us. So again, today we're going to really want to zoom in on consolidation across the ag supply chain, which is something that I had the opportunity to see you speak about at a recent Economic Outlook conference earlier this year. And in doing that, we want to pull forward, I think, from those trends, the troubling and the promising implications that our listeners, who are the owners and operators and leaders of food and agribusinesses, what they should be thinking about as they chart a course for their business over the next several years. And so let's just start with the headlines as relates to consolidation in the ag supply chain space. Where are you presently seeing the clusters or the hot spots of consolidation activity?
You know, Joe, it's pretty well everywhere. You're certainly seeing it at the producer level as the big get bigger. You're seeing smaller or mid-size. It tends to be mid-sized farmers tend to go away. Either they're very, very large or very, very small. I mean, that's a lifestyle situation. Some of those producer or farmer businesses, but the very, very big get bigger and bigger and continue to. But we're seeing it also in certainly food processing. You're seeing it in the elevator industry, the grain handling industry. There isn't a sector in agriculture or the food industry where you're not seeing consolidation. And there's many, many factors driving it. All both internal and external factors that can lead a business owner to decide they want to sell, or to or cause some of those that want to grow to look at opportunities to buy. So it's an opportunity, it's a challenge, and in some cases, it's getting out of a situation that may not be as positive as it could be. Those tend to be minimal these days. It tends to be successful companies buying other successful companies.
And we hear a lot too about the things that also trigger a transaction. So trigger someone being interested in exiting their business. And when you talk about the bigs getting bigger, which I think is irrefutable, that we see that all the time. Do you think that that's a function simply of they have better access to liquidity? Is this because of demographic changes and older owner operators are looking to exit and the natural buyer of those businesses are bigger commercial firms? Or where do you see that? What is feeding the bigs getting bigger without kind of preserving that middle part of the supply chain?
I think you kind of started the question with what's causing people to look at selling. And I think what's causing that, the internal factors, if you will, certainly can be age of a closely held company. It can be the desire to monetize assets. It can be a desire to spread those assets among family members if it's a closely held family organization, or among stockholders if it's a stock company. So that can be part of it. The other piece that we're seeing more and more of, companies just keeping up with regulation, just keeping up with the day-to-day things they have to do to run a business, whether it's a federal regulation, state regulation, payroll, whatever it is. There's a certain degree of resignation that folks just decide, I'm done. Let's pass this on. And I think the third issue is, as you mentioned, is capital acquisition or capital availability. Banks are tightening the reins. There's no question about that. And as that happens, that causes people to really question if they might want to look at an alternative. In terms of the companies that are buying, I think we often say, or I often say, that there's during the last 4 years, the pandemic, Joe, I think there's been those that are haves and have-nots. There's been companies that have done really, really well and have actually banked a lot of capital. And then there's those that may not have been as successful as they would like to have been. And that may be causing some of the urge to sell, if you will. But those that have a lot of capital out there are looking. They want to invest that capital to be productive. And I think that's a major driver of consolidation as well.
Yeah, I think couple of the points you made there that are really interesting is the impact and the implication of just managing the evolving regulatory landscape. And so this is not going to be a pro or a con argument against regulation. It is what it is. It's happening. But I do think that it does generally favor the incumbents when you have higher and tighter regulation because they're able to spread the costs of compliance out across a larger base of operations and a more diverse set of operations. So if you're exclusively a commodity originator, handler, and distributor, you're operating on really, really thin margins. And so those margins get further eroded by the cost of additional environmental reporting, additional employment law compliance requirements, DOT, whatever that might be. And again, not necessarily criticizing those regulations, but that's the reality. But if you're a diversified firm that is also in feed manufacturing, you've got some specialty products, you perhaps own your own logistics, you've got a distribution network in place, and you do commodity handling, you've got a variety of different margin structures where you can distribute those costs, which then puts you in a position to better weather that, I would imagine.
Absolutely. The analogy, size does matter. For example, a smaller operation might have one person with several hats dealing with those challenges, whereas a large organization has a transportation sector, has an environmental sector, has the various sectors that they can fan out across the country to deal with many different issues of their specialty, whereas an individual or a sole proprietorship has to deal with all those, every one of them that comes down the pike. I mean, another example that I use is just kind of as a point of reference. I have a friend that's a very, very large farmer and about 15,000 acres. And they can spread out their equipment so that if it rains in one area, it probably isn't raining 30 miles away, and they can move equipment and they can continue to operate. And we're seeing that size factor impacts the farmer level as well as food service and every other processor in the country as well, because they can do things in some plants that they can't do in others, and depends on when, for example, apples may be harvested in one area, where peaches may be coming in, strawberries. It all, having size and having diversity of option is very, very important. We saw that in the pandemic. A great example of that, Joe, was in the egg industry. those egg producers that only were breakers, that only sold liquid eggs, all of a sudden when that food service market dried up, they were in trouble. But if they were an egg producer that had both shell egg business and liquid egg business, they could flip an awful lot to shell eggs, which was strong in demand because of grocery store sales, as opposed to liquid. So diversity of option and diversity of production is very, very critical. And that's also causing some of that consolidation to happen as well, as some of those companies look to diversify what they can do in their particular sector.
That's interesting. We often, I think there's this broadly held assumption that volatility or disruption favors the small and nimble, right? Because you can adjust quicker, you can seize opportunities, you can move fast, you don't have the bureaucracy, et cetera. But you're pointing out that that's not always the case. And sometimes a diversified portfolio does put you in a better position. I think about in the early days of the pandemic, we all remember the great toilet paper crisis of 2020. There's been studies now, and I've seen literature on this, where the reality was there was no actual shortage. What it was is that some huge percentage of toilet paper that was produced and distributed in the United States went into offices and commercial facilities, restaurants, airports, etc. And when those places were buying, they were buying it by the pallet. They're not buying it by the 18 pack out of Target or Aldi. And so what you had was a distribution challenge. And the companies that had multiple packing facilities where they could either do pallets or they could do individual consumer based, they were able to shift their production to where the new market was. And the same thing happened, I know, in the cooking oil space. We went through a very brief period of time, I think it was in April or May, when there was discussion of running out of cooking oil in some parts of the country. Yep. Well, the reality was the crush capacity and processing capacity hadn't left the market. We just had an uneven distribution of the packaging of, are you shipping your cooking oil to Five Guys or the Byrum household? I'm guessing you guys don't consume cooking oil at the same pace that a fast food joint does. So the bigger companies that had that multiple modes of production were better positioned for that.
Well, it's interesting. Certain retailers, very, very large warehouse retailers, figured out that some companies could pack, let's say, 6 dozen or 7 dozen eggs in a carton, and did that regularly. May have been 10 dozen, whatever the number was. But they were offering those on the shelf, and people were buying them up. And the other piece of that, to your toilet paper example, there were an awful lot of very large rolls of toilet paper sold to institutions. Some retailers were selling those very large rolls, and people were buying those off the shelf. I'm not sure how they put them in their toilet paper holder, but that's not my problem. But the situations where that people were buying anything they could buy, any place they could buy it, I maintain there's still people that have toilet paper they bought 4 years ago. When they could buy it, they went crazy. So it was a packaging issue, and it was a logistics issue. Because big companies that were selling to institutions, food service, if you will, hotels, institutional buyers, they had very little opportunity or very little way to deal with some of the individual retailers. Tough to get from, say, a Gordon food service to a mom and pop grocery store in some small town in Michigan.
That's right. Yeah. So let's dig in a little bit deeper too on from the perspective of the middle to the big side of the market places. So you have folks that are interested in exploring exits. You have, they're tired, they're getting on in years, they want to do something else, they've got liquidity concerns, whatever it is, the cost of regulation. So that is putting businesses onto the marketplace. What are the drivers that are incenting the bigs to actually want to invest and buy up these businesses? Is this looking to rationalize capacity in the marketplace? Is it looking to further distribute their operations? Is it the perceptions that they can buy at a discount? If you're a big, and I know this is a large, broad question because we're talking about all sectors at once, feel free to dig in as you like, but what's motivating the bigs and the mids to want to actually continue to pursue growth through consolidation and acquisition?
The easy one is the farmer level. They have huge investments in equipment, and if they can optimize equipment and the use of equipment, that makes sense for them to do that. They tend to do that, whether it's a large grain facility that might be privately held that they hold for their own use. That enables them to do things they can't do in other arenas. The other one that's significant is market opportunity from the farmer level. For example, if an ethanol plant runs short of corn, as they approach fall harvest, which happened this year in several locations around the country. When they ran short of corn, they weren't going to call a small farmer that might be able to get them 10 or 15,000 bushels. They'd call Joe that could get them 100,000 and get it to them in 3 days.
And we want trucks 24 hours. Yeah. Just
Bang,
yeah.
put all 4 combines in one field, run it, bang, knock it out. And the food service level, food service and those that supply retail, a little different drivers toward consolidation. We're finding that those big food service operators, the big retailers, we hear a lot about farm to market. We hear a lot about it, but those big users, those big buyers want to deal with as few suppliers as they possibly can. They want to minimize their exposure to the market, and they want to also maximize their food safety and quality control issues. And when they deal with a company that they're confident in, they want to deal with them more. We're seeing that across the board. We're even seeing some of those big retailers building their own facilities to guarantee product and guarantee quality. Those are big issues in the industry and going to continue to become larger and larger and more important as we go forward.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
That's kind of counterintuitive to some of the things you hear about coming out of the pandemic. And obviously, we've mentioned COVID here a half dozen times, so this is not going to be evergreen content. And in 10 years, someone's going to say, what are they talking about? But you heard so much about supply chain resilience and making sure that you didn't have over-reliance on a particular small number of suppliers. And so the idea that large food service companies want to minimize their market exposure and have fewer suppliers, that's different than the story we've heard. I wonder is that because largely they're looking at domestic suppliers and some of that supply chain resilience rhetoric was talking about more offshore supplier relationships that you want to build resiliency into?
That's a great point. Imports were zeroed out. I mean, Long Beach basically shut down. You couldn't get containers off ships. So domestic users wanted to bring that demand back to the country, back to the U.S., so that they could make sure they accessed or at least could touch and feel where that supply was coming from. Watching those container ships sit in Long Beach, the entire Christmas decor sector for 1 year was basically lost as an example because it was all sitting on ships in the Pacific Ocean. Not that pertains to food service or food industry, but there were an awful lot of imports that were sitting there that didn't get moved as well. And by the same token, there were a lot of exports that wound up sitting here as well, which they weren't able to export primarily nut crops, anything from the West Coast. Edible soybeans were boxed up for months and months and months before they were able to get across the ocean. A lot of those kinds of things really caused people to refocus how they were looking at their supply and want to be able to touch and feel where the stuff was coming from. And that's a very broad statement, but Joe, you're spot on. They were buying from anybody they could buy from during the pandemic. Now they want to bring it back and be able to control it a little more close to home.
Yeah, the short memory of pain. But I guess if it is, I'm making a presumption here, but if you do control your supply, the supply side of the chain, and you keep it within the 4 walls of wherever you're based, so within the United States or Canada, or even just North America regionally within the confines of the previously named NAFTA agreement, that does provide a little bit more assurance, right? That some of those import-export things aren't going to break down quite as quickly as they did elsewhere in the world. What, if any, I'm guessing the answer is there's some, but what role do you see private equity playing in the pace or the focus of consolidation from a driver standpoint? Does the fact that PE money is finding its way into the ag supply chain then create in the aggregate more consolidation because the incumbent traditional players are also they're then starting to cut more checks to buy more businesses?
That's a leading question, and you're spot on, and you know the answer to that. Absolutely, private equity is driving an awful lot of consolidation, and they're easier to deal with. Obviously, a lot of those PE firms are specialized. So when they talk about, let's say, a food processing industry or food processing business, they know what they're doing. Whereas banks today, The one problem we're seeing with banks is a lot of the expertise in certain sectors, especially in agricultural related sectors or food related sectors, a lot of that expertise is retiring and not being replaced with the kind of experience that was there. So it's becoming more and more important that those PE firms that are specialized are at least on the radar screen of any of those business looking for financing, funding, or capital needs as they go forward. A company I'm very, very familiar with, a major regional bank, asked them to seek an alternative bank. Never had a loss in the 100 and some years they'd been in business. Never had a negative year. But the bank just didn't understand how the business operated as they were going forward in the next few years. They didn't understand, for example, Joe, what a margin call was and why you had to pay a margin call within 24 hours after it was in demand. And this is a bank that we would all know the name of, but they didn't have the expertise in-house anymore to really understand or manage that risk. And we know how risk averse banks have become recently. And that's just a symptom of it that I just found really hard to believe.
Yeah, well, I heard in the work that we do with clients, oftentimes they're first time acquirers. And so in the wake of, they typically have their financing lined up when they enter the deal.
Or have cash.
Or have cash, or it's a stock transfer or some kind of a structure that allows them to reduce their lending requirements. But typically there's also always some leverage of debt. Now, the proportion of that I think varies with the sector and the nature of the acquirer. But we see in the wake of that transaction when suddenly their liquidity requirements, they get bigger, but they also change.
They exceed projections.
Yeah. Well, I remember talking with a client a couple of years ago, and they were kind of in a recess from a board meeting. They're kind of poking fun and making jokes at their regional lender that they had to once again explain why they had drawn down their line of credit, their revolver, why they had drawn it down at 90%. And they do this every year because we all know that typically, depending unless you're a double crop commodity, you get one shot on goal a year. And all the businesses that serve farming also typically have certain spikes in types of activities that you do. And so each year they would draw down their LOC at 80 to 90%. And each year, whoever their new relationship manager that had been assigned to them in the last 12 months would get really panicked and give them a call and say, what's going on? Is everything okay? Our risk exposure has suddenly gotten much bigger. And it's like, well, it hasn't. That LOC has always been out there. That's your exposure. We're simply utilizing the facility you provided. And they would say, well, you didn't use it for 10 months and now you've nearly 100% utilized it. They said, well, that's why it's there. And they would joke that not every year, but every couple of years, they would have to re-explain this to their lender. And they're effectively explaining to the lender what their business was. And so this really rings true. I do think that you have a knowledge gap, a familiarity gap. I don't want to say a competence gap necessarily, but it does feel like the ag lending space is evolving under our feet.
Well, we're not a manufacturing plant. A farm isn't a manufacturing plant, and the food processor doesn't operate at the same level or 12 months of the year. The reason I was smiling when you were talking about that is I love the multifaceted ag supply and grain handler business because they'll have two big drawdowns. They have the big drawdown to put in fertilizer, pesticides, and seed. Then they'll pay some back in the summer. Then a big drawdown at harvest. And then they pay it all back. And, it's just a continuing revolving cycle. And banks that are bankers, relationship managers that aren't familiar with that, as you say, get really nervous. Even though the exposure doesn't change, they're the ones that provided the facility based on the equity and the ability of the company. But they get nervous. It's
really funny. The exposure hasn't changed. It's almost like, whoa, you wonder what's happening within the four walls. Like thinking, shoot, these guys called our bluff. They're using the debt that we approved.
Yeah, using the cash. But that's why PE is specialty PE is becoming increasingly important, and why some of those traditional farm lenders are becoming increasingly important as well. And they're claiming a bigger share of the market. Those that have the expertise, where you don't have to explain what a margin call is or why you draw down on the fall at harvest. Those are big issues, especially for customers that want to have consistency. Let's be blunt. A business doesn't want to get those nasty calls or those questioning calls from a bank either. that causes them a little heartburn in their blood pressure to go up, even if it's not a negative call, and even if it's an information call. Those relationships are always a bit tenuous.
Yeah. Well, I guess the upside of the downside here is that this provides an opportunity to benefit the legacy ag focused lending institutions that have specialized in this, the Farm Credit System, other regional banks that have built up
Yep.
an ag practice that really understand it, that should put more of that deal flow and that business in their direction, which they're well positioned to serve.
Mm-hmm.
And they're well equipped to understand and provide good top quartile advice too. So I guess that's maybe the bonus here is that the business now flows to where it probably will most effectively be served.
And traditional farm credit has great expertise and experience. Regional banks,
Absolutely.
in particular, if they have a strong ag book, strongly recommend they have an understudy or two, because those folks are going to be in strong demand in the financial world coming forward.
Absolutely. Well, this kind of brings us then to perhaps the most important part of the discussion is, so what? And I think we've teased at this a couple of times already over the course of the discussion. But what risks and opportunities do you see this creating along the ag supply chain? Meaning, what should some of the companies be thinking about or preparing themselves to do to deal with the accelerated rate of consolidation? I mean, if you're a small to mid, what do you do to fortify yourself? If you're a big, what do you do to put yourself in a better position to capture opportunities?
Joe, I think another consideration when one is either buying or looking to sell is that a company that's acquiring doesn't want to acquire a dog. The only companies they're interested in acquiring are those that are well operated, that are current in technology, that actually bring something to that acquiring company. They don't want to buy fix and repair companies. They don't want to do a fixer upper, if you will. And I think it's important for those mids and even the smaller folks to stay current, stay on top of things. Don't let equipment depreciate to the point that it's a constant maintenance challenge. And the other piece that is interesting, I think, especially in agriculture, is that we're finding a lot of food processing companies, or processing plants, I should say, that are located around the country. An awful lot of them are located where the raw material is or was. And we're finding situations where it is a was. And those plants, bringing them online and up to speed is going to be very difficult, if possible at all. So we're finding an awful lot of green construction in the food processing industry. But to make sure that you're not left out of that equation, if you're a mid or a smaller operator, make darn sure you have something to offer others, or you do something maybe, or have a product line that maybe others don't. You have to be attractive to a buyer. It doesn't, they're just not going to shovel money your direction just because you exist, even if there's a solid market share. If the plants aren't in good shape, if the workforce isn't happy, an acquiring company doesn't want to buy problems.
Yeah, I mean, that's really important. I think so much of the seller equation or the seller prep playbook that we've seen traditionally is make sure you have audited financials. Make sure you can provide a quality of earnings. Make sure you can provide clean books, which is incredibly important because that gives a buyer a very clear-eyed view on what has happened in the past. But being well positioned in terms of your spot in the marketplace, being well positioned geographically, having the ability to demonstrate how you delivered those results in terms of your processes, the way you maintain your assets, how you manage and develop your people, how you protect and then invest in technology. So much of the equation on the acquirer side is, we want to know the books, we want to know the numbers, but we also want to have some level of assurance that those numbers are indicative of what we will produce again in the future. And if you have done all the work to prep yourself, but it's only in the rear view, you're likely to invite more skepticism, some harder questions, and you might even scare off potential acquirers that would have been a great fit for your business.
The other equation, the other piece of that is quality assurance, making sure that what you're producing is meeting the requirements of major customers. And, more and more, that's something that companies look at very, very closely when they're acquiring. They don't want to buy a company and have to do a recall the next day. Recalls are an anathema to very, very large operations, and that's something folks have to pay attention to. It's a pain. Maintaining those quality standards, watching the quality issues as the product comes out of the line is critical. It's absolutely critical. And if you don't have those solid processes in place, you're going to be less attractive.
Absolutely. Well, as we look to bring this to a close, anything else, Jim, that we didn't cover today that you wanted to mention or share with the audience?
All companies aren't going to be huge. There's still lots of opportunities for niche businesses and things that companies do want to buy or do want to offer, or new technologies or new products. There's always lots of opportunities for those kinds of things, and look for those opportunities. Look for the kinds of things that you might be able to offer that others can't or don't or will not offer. And there's opportunities out there for new businesses. We see it all the time, and it's a great industry to be in. They don't all have to be huge, but ultimately the consolidation in some of those major commodity sectors and major sectors across the chain is going to continue, but there's always going to be opportunities for newbies to start up.
Yeah, I don't know that our listeners all aspire to run multi-billion-dollar multinational organizations. There's a nice sense of control and purpose and intentionality with running a business of a certain size that meets your community needs, serves your customers well, manages complexity, et cetera. But what I hear, it's important to remember that size and scale is not a proxy for success. And there's a lot of large companies that do a ton of volume, but if those margins as a result are negative, if you have negative unit costs or you have very thin margins, you can create a pretty profitable and attractive business with wider margins at lower volume and lay off a lot of those headaches and lay off a lot of the complexity and the heartburn along the way. So I think that's a good caution that not everyone's going to be big, and that's fine.
The other piece is we're in the money business. As I often use the phrase, profit is not a 4-letter word. And the big guys, as you get bigger and bigger and bigger, there's efficiencies, there's things you can do better, but it also limits some of your diversity potentially. Whereas some of the smaller folks can do things at a higher margin, lower volume. And the objective, as we say, is to make money.
Never forget that, right? Fantastic. Well, Jim, it's always interesting to hear your perspectives on agribusiness. And like I said, I've had the opportunity to sit in and see you speak a number of times. And for anybody who's looking at a potential conference, a program, and you see Jim Byrum's among the speakers, that should be your default to go ahead and register and make sure you attend a session. I also appreciate your ability to weave together. We cover some really complex economic and environmental issues here, but I always appreciate how you can package them in a way that's very understandable, very actionable, pretty straightforward. And so I just wanted to thank you again for taking the time to be part of the Pacesetter Pod today.
Joe, appreciate the opportunity. It's been a fun conversation, and it's one that is going to continue. This is kind of a beginning of, or not even the beginning. We're probably in the middle of this whole trend, but it's going to continue, and we're going to see changes and opportunities and challenges in the industry going forward. No question about it.
A fantastic, exciting time to be in this space. Thank you, as always, to our listeners for tuning in today. Please remember to like and subscribe to the Pacesetter Pod wherever you get your podcasts. You can find me, Joe Mosier, on LinkedIn. And if you want to explore how we can help your agribusiness better execute strategy or M&A, you can set up a call with me directly from our website at www.mosiercg.com. Thank you for listening, and have a safe day.
This is the podcastfactory.com.